Good day, students of AP Economics, HGP. Can't believe it's already Thanksgiving. What are we doing this week? Unfortunately, you will not see my happy face this week. I have last on Monday, only 30-minute class, one class on Tuesday, plenty of academic exercises for you intelligent, articulate young economists to be working on in my slight absence. So have yourself a tremendous Thanksgiving with your families and friends. We will reconvene on the 27th of November. In between now and then, what do you have to accomplish? Okay, first, AP classroom assignments, snapshot of that on the next slide. Slide number 2 is a summary of an article from Business Insider, which does an excellent job of correlating to what we just learned about risks in many ways. And finally, the last slide is just a summary of the Chief Economist Delta Airlines assignment, which has already been shared with you through email and also made available on Schoology. Unit 4, AP Classroom Assignments. We've actually covered 4.1, 4.2, 4.3 in class and talked to a decent amount directly as well. 4.5, we talked about the money market in class. So some of this will be new to you, some of it will be reviewed to you. I've extended the due dates on these AP classroom assignments. Please watch the video, take the quizzes, get these done. Right. On the next slide, excellent application of the 4 types of risks just covered in class. This relatively brief article from Business Insider, excellent application of ideas just covered in this class, multiple economic concepts, especially the concepts of risk that we just discussed. So the article is entitled "The Stock Market is Edging Toward Extremes of Great Depression and Dot-Com Eras." It is from Anil Varma, right, from November 17th of Business Insider. Key takeaways up top here. Stock valuations by one measure have hit highs surpassed only a few times in history. So imagine some of you might want to get into the world of finance and become advisors/analysts in this industry. So this is a bold statement here that stock valuations, or when you look at the price of stocks relative to their earnings moving forward, their potential earnings, and other investments, that by one measure the stocks seem frothy. They just seem overvalued, right? So start thinking risk. This might be a really good example of, right, something we called market risk, that there might be market risk involved with owning stocks. Equities look historically high relative to government bonds. So we're going to talk about the idea of owning risky stocks versus owning risk-free, virtually risk-free government bonds. The market's upbeat expectations on future corporate earnings may face disappointment, right? So this is from PIMCO. After a rally that defied the high interest rates, recession calls, stock valuations are now edging towards levels seen before some of the greatest market meltdowns in history. So good analysts look at, not where we are presently, but where we're moving in the next 6 months to 18 months, and then they try to evaluate risk of owning these equities. A time-tested way of assessing whether equities are fairly valued. Right, this is an excellent point here. Right, are stocks fairly valued is by comparing them with government bonds. So here's the idea. Would you rather own a risk-free government bond with a guaranteed interest rate, or would you rather own stocks which are a risky asset class, right, with no guarantee of increase in value? Now, obviously, went over this in class where, generally speaking, the greater the risk, the greater the reward. But the question is, at this time, is it worth owning equities relative to government bonds? And by that metric, stocks are looking historically expensive, right, according to these analysts. A key measure of the richness of stocks relative to debt is a so-called equity risk premium. So write that down. It's an important idea. when you talk about how do you value, I measure the richness of stocks. Are stocks overvalued? The equity risk premium, or extra return on shares over treasury bonds. So in other words, if you're looking at stocks and you're like, geez, I'm going to get a return of 9%, treasury bonds are only paying 3%, that's a pretty nice little premium there. The metric has plunged this year, indicating stretched stock valuations toward levels seen during the Great Depression of the 30s and the dot-com of the late 1990s. Delve deeper in historical data, we find that in the past century, there have been only a handful of instances when equities have been more expensive relative to bonds, and it says, such as the Great Depression and dot-com era. History suggests equities likely won't stay this expensive relative to stocks. So these analysts are calling for what we call a correction. All right, they're calling risk on, right now this is market risk seems pretty significant in the equities markets. The historically low equity risk premium is a deterrent to investing in stocks. According to these analysts, it means stocks are offering investors little incentive to choose them over risk-free assets such as government bonds, and that may turn away potential buyers. The equity risk premium is very, very narrow. I just kind of said that. Now, in fact, it's actually almost negative. And that is a major concern because what it is saying is that actually you don't need to invest in equities in this short to medium term, because if you invest in 6-month treasury bill, which is giving you 5.5% completely free of risk, then that's actually a risk reward that is completely unbeatable. So think about that. Say, okay, I could take my money, invest in government bonds, get my guaranteed 5.5% return. You're not taking much interest rate risk there because you're only turning your money over to the government. You're loaning the money to the government for 6 months. Right? And you're eliminating the market risk if stocks go down in value. U.S. stocks are on track for their best month in a year. Expectations the Fed's done raising rates, right? We talked about that in class. Right, so expectations that the Federal Reserve may have reached the end of its interest rate increases at a time when the economy remains resilient and inflation has moderated. So the S&P 500 is up 7.4% in November, taking its year-to-date gains to 17.3%. Not bad, right? Not too shabby, but hey, you got your 17.3%. Might be time to duck, dodge, run for cover amid optimism that corporate earnings will remain buoyant in coming quarters. Now there's the key. What does the future look like for corporate earnings? However, PIMCO cautions against this outlook. We feel that robust forward earnings expectations might face disappointment in a slowing economy, which, coupled with the elevated valuations in substantial parts of the market, warrants a cautious neutral stance on equity, favoring quality and relative value opportunities. Just a really good practical example of ideas we've been covering in class. All right, before I say sayonara and happy Thanksgiving for one last time, the Chief Economist Delta Airlines assignment. What is your job with this assignment? So you're the Chief Economist at Delta Airlines, and you've been commissioned to write a just one page, right, intelligent, articulate summary and analysis with advice to the CFO regarding future airline decision with 2 potential technological advancements in the industry: hydrogen cells and SAF, sustainable aviation fuel. So you understand as an economist in the airline industry that the airlines are under pressure to reduce carbon emissions, and you understand that jet fuel is a significant cost of production for airlines, 22% of operating expenses for airlines. Right? So your job then is to evaluate both of these potential technological advancements, which could be a replacement for traditional jet fuel, which is extracted from oil, of course. Right? So you're going to prepare this one-page analysis analyzing economic analysis of the two options. And you have three parts of this analysis. First, definitively explain the two technologies. Now, you don't have to go researching the internet. The two videos explain the technologies of hydrogen cells and sustainable aviation fuel, but you need to explain to the CFO what are these two technologies, right? Definitively doesn't mean long explanation, means clear explanation. Then provide a detailed economic analysis of the costs and benefits of both options. Again, the videos highlight, explain, and examine the costs and benefits, the economic potential costs and benefits of these two technological advancements. Finally, and definitely not least, outline a definitive course of action. What should the airline do over the next decade in regards to adopting either of these two technologies? So what are the rules of engagement? All right, number one, please work on the assignment by yourself. Without the assistance of technology, without the assistance of another human being, it's not a lot of writing, it's more a lot of thinking, analyzing. Put your economist hat on, get that brain churning, right? Make sure you address all three aspects of the definitive, explain the two technologies, detailed economics, cost and benefit, and the definitive course of action. Right, but provide intelligent, articulate, succinct ideas, answers, and solutions. All right, good luck. Have a happy Thanksgiving. Looking forward to seeing all of you in about a week.